Okay. See, you are entering into a complete new world today, and this chapter is very important. This particular, the entire groups, what you are going to study is very important. Okay, because you can expect a 20 marks question from consolidation, and you can expect some 4 to 5 MCQs even that will fetch you 10 marks. So it's a 30 marks chapter. Fine. Now, so group accounts. Fine. So what do you mean by group accounts? See, there was a company called Maruti. There is a company called Suzuki. These two joined. That means it is called a amalgamation. What is that? All of you?
Amalgamation.
What do you mean by amalgamation? Amalgamation is nothing but two different companies. They kind of merged with each other. Okay. And now they are having a single entity. That is, and they kind of prepare this particular amalgamation has led to the consolidation of accounts. At the end of the year, they prepare a group account. What do they prepare? Please tell me.
Group accounts.
Group account. Then what about absorption? In this, A company will acquire B company, but again, what will happen? Only A company would be existing. B's existence is not there now. Okay. So we will not go into amalgamation. So here, like Flipkart and Myntra. Flipkart acquired Myntra, and now Myntra is a part of Flipkart. It has no existence. Now don't tell me, sir, they are selling the goods by the name of Myntra and all. That's a separate strategy. But Flipkart, it is completely, it's all the assets and liabilities are taken by Flipkart, and they will prepare. Now Flipkart will have its own statements at the end of the year. In case of Maruti Suzuki, it's a different entity. It's a different entity, and both are separately functioning. But again, at the end of the year, since they got merged with each other or amalgamated, so amalgamation is a term used in United States. Merger is in UK. So now they'll prepare a consolidated statement at the end of the year. That is group accounts. What is that? Yes, that is group account, correct?
Yes,
all of
sir.
you. Yes. Now, please understand. Many large businesses consist of several companies controlled by one central or administrative company. Together, these companies are called a group. So the controlling company, so here, now let us leave this amalgamation, absorption, all this picture behind. Let us say there is a company, there is a B company. A company can acquire 100% shares in B company. So B company will be called as so here, when A company acquires 100% shares in B company, A company would be called as, B company would be called as
subsidiary.
But in this case, I would say B is a fully acquired subsidiary.
Wholly owned subsidiary, like
Sorry?
wholly owned subsidiary, no? Sir?
Wholly owned subsidiary, fully acquired, wholly owned. You can say anything. This all right. But what, as far as consolidation rules are there, okay? If A company acquires 51% or more than 51% shares in B company, then also A would be called as B's and B would be called as A's. And in this case, A has a control over B. What is that? This is a very important terminology, boss. Control over B. A has got control over B. Now, what is that control and how, in what ways the control is defined in this chapter, we are going to see in the coming slides or pages, correct? Now, so the controlling company called the parent or holding company, because they have holding in another company, will own some or all of the shares in other companies called subsidiaries. So here A has, if suppose B has a capital of 1 lakh or B has 100 shares, for example, or 10,000 is the capital of B, and A has like 60 shares in B, or A has $6,000 worth of investment they have done in B, or acquired B 60%, they acquired stake in B. So A would be called as parent, B would be called as subsidiary, or A would be called as holding. Okay. Now, can you tell me what is that 40%? 40% would be
Non-control interest.
non-controlling interest, NCI, or minority shareholders. They can be public, or they can be any group of individuals, or B company can have that, not a problem. Now, so till here, as far as I am concerned, we are clear with the concept. Point number 2. See, why do businesses like operate as groups? There are many reasons for businesses to operate as groups. For the goodwill associated with the names of the subsidiaries. So definitely, if parent company wants to acquire subsidiary company, because the reason can be because subsidiary company may have a very good business in that area. Subsidiary company may be very good, maybe having a good market share. So if that company or some stakes in that company is acquired, we also get access to that market, correct? That may be having very good, it may be having goodwill in the market. Now Ford company wants to sell all its assets in India, Ford India. Tata wants to buy it. So that can be a reason. Or you know, like what happened when Hero was Hero Cycles, and then Hero Cycles had a very big network in India. Even though every small town, they used to have an outlet, because you know, I'm speaking about 50 years back, during our grandfathers or our fathers' young age. Okay, they used to ride cycles. These bikes, Honda, and all this were not there. And that time, the financial sector was also not that strong, because we did not knew all those things in India. In America and all, they were very much advanced in all this. All this finance sector and all have become very much prevalent like 15-20 years back. Finance sector was there, loans were given, but not as aggressively as today. So Hero Cycles, they only knew how to make the parts of a cycle. Okay. And Honda was a world leader in bike making or engines.
Right.
You know, Honda is one of the best companies in the world. They make the world's best engines. You take any Honda bike, you can't compare the smoothness of that bike with any other bike. So now what happened? Honda wanted Indian market. They saw potential in India. Hero also wanted something they could like offer to their customers more than cycles. So these people got the market share of Hero Cycles, and Hero Cycles got they got some good business, because now cycles are already been sold. They did not stop the cycle division, but they are also entering into the bikes market by making the parts for bikes. So they are getting dual business, correct? So Hero Cycles and Honda, they merged, and kind of they became Hero Honda, and then it become like they became if they want to make a statement at the end of the year, they have to make a group company consolidation. Now, so in many countries, company law, so we are here, yeah. So there can be the groups can form, or the parent company can acquire subsidiary company for various reasons. Okay, for like as I said, Hero Cycles market, the Honda got, and they made a company called Hero Honda. Now you know Hero Cycles is different and Honda is different. Okay, now they have kind of they are not a group now. They are not they kind of parted their ways. Okay, they liquidated that company now. for tax or legal purposes and so forth. There can be various reasons. Why tax? Can anyone give me an example of this?
Group may get profits, but individuals may get losses, and they can recover those
No, like
unobserved losses.
I am not completely satisfied with this. You know this
Sir.
transfer pricing?
Yes, sir.
What is transfer pricing?
So if the group company is having the final, the commercial transaction, especially business related transaction, purchase or sales,
Hmm.
that will be called as a transfer pricing.
No, no.
It's a,
See, transfer pricing is correct, but how they take tax advantages? For example, now suppose there is a company A and there's a company B here. Okay. So you know what is this terminology arm's length? Arm's length
yes, sir.
transaction.
Yes, sir.
No,
Yes, sir.
sir.
See, arm's length transaction is nothing but this is between two people who don't know each other. Okay. So that any of the parties cannot influence each other for anything. For example, now you have joined me. In future, okay, I will not take my example. Sorry, again, you'll take advantage of me. Fine. Suppose there is A and there is B, and A is B's brother. Okay. So now B goes to A's shop and B says, I want some 10,000 rupees worth good. And like A says, fine, okay, I'll give you. Now when it comes to paying, when it comes B paying to A, B says, I'll give you 9,000. That's it. Whatever you do, I don't know. Whatever your problem is your problem. But you are my brother. I want to take advantage of that. And he pays 9,000. So this is not arm's length transaction because these two are not independent to each other. They know each other. They are related parties. Okay. So B can take advantage of A because A is B's brother. But what happens? This is not arm's length. Okay. Related party transaction. This is we call related party transaction. Here A and B are two parties who don't know each other and no one can influence each other. What A quotes to B, B will pay to A. Some bargain like a normal customer they would do, not a problem. But like so for example, he wants him to reduce some amount. So 950, he says 9,000, 950 you pay me, no problem. That 50 rupees discount is a negligible discount. But this is called a arm's length transaction. When it comes to transfer pricing, there is no arm's length transaction which is going on because A is the parent and B is the subsidiary. Maybe A is in some state called Nevada. You may be knowing about Las Vegas and all. And B is in the state called, let us say, Hawaii. Okay, there are many states, Texas and like a lot of states are there in United States. Okay, so tax rate in Nevada is somewhere around 20% and tax rate in Hawaii is somewhere around 30%. Okay, now what is happening here? What A does is A sells goods to B, lot of goods to B. Okay. See, A can take dual advantage. A can sell goods to B at a cheaper cost. A can sell the goods to B at arm's length also. Are you understanding what I'm saying? Hello?
Yes, sir.
So A can sell many customers in his area also. So what A decides, if he sells goods to people in his area, he would earn some good profits and he needs to pay, let's say tax here is 30%. Here it is 20%. Let's say. So now A sells, if A decides, if he sells lot of goods to people in his area, so he need to pay how much taxes? What A decides is to save that 10% extra on taxes, he decides to sell lot of goods to B. Let us say arm's length transaction. He decides to sell goods to B or he decides to sell goods to B at a cheaper rate. Anything. So B can get if A decides to sell goods to B at cheaper rate and B decides to purchase those cheaper rate goods at bulk and he can sell it at higher price in the market, correct or wrong?
Yes, sir.
Yes, sir.
See suppose A is selling an item to his customers at 100 rupees and he sold 1,000 rupees worth of goods. For example, he got 1,000 rupees profit. A sold some 100 items to people in his area, and he is selling those 100 items at some price, suppose say 10 rupees, and he got 1,000 rupees. Now he has 1,000 rupees profit, let's say. Let's not say this is revenue, profits. He needs to pay how much taxes?
30%.
So he needs to pay 300 rupees. Am I right?
Yes, sir.
What A decides, he will sell goods to B at a cheaper price, cheaper rate, say 8 rupees something, and B will purchase the goods in bulk, or let's not go in details of transfer pricing. You don't have this. A sells these goods to B purposefully instead of selling the goods in his market, and asks B to sell those goods in his market, and B gets a profit of 1,000 rupees, and taxes paid in that area is how much? At the rate of 2,200. So in this case, are they saving 100 rupees?
Yes, sir.
This is what they do in transfer pricing. They try to sell the goods to the related parties to save taxes. So these kind of things they do. All these things are not there for you, but kind of I am just giving you a small idea. In future, you're definitely going to learn all this. Okay. Now, in many countries, company law requires that the results of group should be presented as a whole. As Mr. Srinivas said, wholly owned subsidiary, he was using some terminology. Yes, that's absolutely right. Unfortunately, it is not possible simply to add all the results together, and this chapter and those following will teach you. Okay, fine. This chapter we will be dealing with consolidation. Okay. In traditional accounting terminology, a group of companies consists of a parent and one or more subsidiary companies which are controlled by the parent. Now, what do you mean by control? Let's see here. Control. An investor controls an investee. Investor is parent, investee is subsidiary. When the investor is exposed or has rights to variable returns, suppose there is a shop here, shop A and shop B. Shop B is kind of, let's say A has invested in shop B. Now, whatever returns this shop B generates, okay, those returns will not be fixed returns. Those will be variable returns, correct? A has right to enjoy those returns or not? Please tell me. A has right to enjoy the returns in B or not? Because A has invested in B. Please tell me yes or no.
Yes,
Yes,
sir.
sir, it has.
If you have a shop, if you already are having a shop and one more shop you open in some another area, that shop is earning profits. So will you not be taking that profits with you? You will be enjoying those profits, correct? So can I say A has control over B?
Yes, sir.
Yes, because whatever profits B is earning, A will enjoy those profits. A will decide what to do with those profits, either to keep with him, either to spend anywhere else, either to reinvest, either whatever should be done with that profit, A will decide. So definitely A has total control over B. Now, so an investor controls an investee when investor is exposed or has rights. So let us leave this word exposed, not to confuse. Has rights to variable returns. Variable is not fixed. That means B's returns can be 10,000, 5,000 at times, anything. But why A is able to, A has rights to that variable returns, or A has right that he should get the returns of B? Because from its involvement with the investee and has the ability to affect those returns through power over investee. That means A is involved with B. A is involved with B. In what ways? Because A has invested in B, because A owns B. That's the reason why A is involved with B. So whatever returns B generates, A has a control over them. A has the rights to enjoy those returns, and A will decide what can be or what should be done with those returns, because A has the power to do that. So did you understand here? Two words you have come across. One word is control and one word is power. Understood? All of you?
Yes, sir.
So what is control? Whatever returns B generates, A will decide what should be done with that, either to keep, either to invest, either whatever he wants, he will do. And he has power for that. He has the power to do that. Now, what is power? Existing rights. Yes, A has the rights. that give current ability. Yes, A has the rights which is giving A the ability to direct the relevant activities of investee. That means A will decide what should happen in B, how B should like run its business. A will decide and tell them. A will tell the managers or his people in B, you should do this on this given day. I want some 100 units of sales per day. So whatever these things, the directions are given by A to B. So can I say A has power over B? Yes. So now
Yes,
again,
sir.
last repetition of this. Control A and B. There are two shops. A has invested in B. Maybe A is 100% owner in B. So whatever returns B is generating, A will decide what should be done with that. Either to keep, either to enjoy, either to spend or whatever. And that he is doing because he has power to do that. Now, what is power in this context? Power is nothing but A has the rights to direct all the relevant activities in B. That means on A's instruction, B should run his business, or shop B should run its business on the instructions of shop A. Then we can definitely say that shop A has power over B. So power and control will definitely make A the parent of B.
B.
Okay. So here we are very clear with our definitions. Subsidiary, which is controlled by another entity, which is parent in this context. Parent, the one which controls one or more subsidiaries. Group, parent and subsidiary clubbed together is a group. What is the difference between a parent, a subsidiary and associate? Can anyone tell me? Just give me a second. I'll drink some water and come. Just a second. I'll be back. Hello. Yes. Can anyone tell me what is the difference between a subsidiary and an affiliate or associate? See, parent, subsidiary, 51%, more than 51% holding in this company makes this company as a parent of this company, correct? If I say more than 25%, but less than 51%, if XYZ company has invested in ABC company and the holdings what XYZ company has in ABC is between 25 and 51, then ABC would be called XYZ. Come on.
Parent
Yes, sir.
company.
Not parent.
Associate company.
Yeah, associate. Okay.
Sir, can you explain once again?
What did you understand? Please, can you repeat?
Sir, this I didn't understood, so this concept.
I have written something here. Rajeshwari, can you read it out, please?
So this
I'm ready to explain, but I want what did you understand, please?
means like this one, so like greater than 51%.
See, XYZ company has done investment in ABC company. That means XYZ company bought 30% shares in in ABC company. That 30% is between 51 and 25, na? It is more than 25 and less than 51.
Less than 51.
25,
It is between 25 and 51.
So this is more than this, na?
Yes, sir.
But less than this. So when any company has done an investment in another company to the tune of 30%, 35%, 40%, 45%, that comes in category of what? 25 and 51, between 25 and 51, correct?
Yes, sir.
These are like, see, actual figures. Let me see what they gave in the textbook. This is what in generally we generally explain to students. Let me see what these guys are saying, because company accounts differ everywhere, na? It's not the same like. Okay, they are saying 20%. Okay, fine. Chalo.
So sir, 20% till
Okay, let me
between
let me
20% and
yeah,
51%.
let me give a clarity to you. Fine.
Okay, sir.
So for if there is a company A and there is a company B, see, don't test me on figures. Don't tell me sir is teaching wrong thing and all. Just for understanding, I'm giving all these figures. The figures given
Okay,
in the
sir.
textbook are this. So A company has invested in B company. A company, if acquires 60%, 70%, anything, that means the rule is more than 50%. What is the rule?
More than 50%.
More
More
than
than
50%.
15%.
If any
50%.
company invests in another company, or if A company invests in B company, or if A company has holding in B company of more than 50%, then A company would be called as
Parent company.
parent of B company, and B company would be called as
Subsidiary.
Subsidiary.
this is clear. Now comes associate. Now A company and B company. A company has 20% holdings in B company. How much?
20%.
20 or 30 or 40, but less than 50. That means, can I say 20 or more than 20, but less than 50? Can I say this point? Can I say
Yes, sir.
if A company has invested 20% in B company, that means B company's share capital is, suppose its share capital is $10,000. So A company has taken $2,000 stakes in B company, or $3,000 stakes in B company, or like less than 50, more than 20, or equal to 20 in B company. Then A company would and B company are what called? What are they called
Associate.
together?
Associate.
Okay, this is just a group structure, not some rocket science. Very
So
simple.
sir, here B is called as an associate, sir.
Both are associates to each other. Na? Associate means what? No one has
Okay.
control over each other. That's it.
Okay, sir.
Here A has a control over B. So A is parent. But here either A is not controlling, B is not controlling each other.
Yes,
But
sir.
some power A would have, because A is a
Parent.
investor, not parent here. How A
Oh,
parent
okay.
of B? They have not invested more than 50%, na?
Yes, sir.
A has invested in B, of course, but only to what extent? 20%,
Less than
either
50.
30%, either 40%, which is nothing but either equal to 20 or more than 20 but less than 50. Tell me. Yes? Yes. Now,
Yes, sir.
Yes, sir.
so since A is an investor and A has stakes in B, A will definitely have some upper hand. We will see what kind of upper hand, okay? Now all of you understood about this structure?
Yes, sir.
Sure, we'll
sir.
move on. Yes. So let's say what kind of upper hand A has over B. A has significant influence over B. What is that? See,
Significant
yeah,
influence.
in case of group, that means in case of parent and subsidiary, the parent has power, so first of all control and power over the subsidiary. Okay. In case of ABC and XYZ, let's take two companies, and here the investment done by parent is 60%, let's say. Here ABC has invested 30% in XYZ. ABC has invested what? 30% in XYZ. So XYZ is what of ABC?
Subsidiary. Associate.
And ABC has what over XYZ?
Significant influence.
Significant influence.
Yes, they are having more than 20%.
Yeah, because they have a bigger influence over XYZ. a higher influence. That means they are more powerful than XYZ in this case. However, they will be because they are investors. Okay. So these guys have a influence. That means a very important influence over XYZ, over their associate. Now, what is that important or significant influence? Let us check. So that significant influence here is nothing but the power to participate in the financial and operating policy decisions of an investee, but it is not control or joint control over these policies. So what is happening? The ABC company and XYZ company, whereby XYZ is an associate of ABC, ABC has the power to participate, not bestow or not force. What is that here? I'm just using a term here. ABC can participate in they have the power. Yes, of course. Because they are big investors now, they can sit in the annual general meeting and all. They have the power to participate in the financial and operating policy decisions of XYZ. That means whenever there will be meeting, in that some decisions related to financial or operating policies have to be made. In that, ABC has the power to participate and even get itself involved in that decision making. But these guys cannot enforce those decisions on XYZ. Why? Because they don't have control over XYZ. Got my point? All of you?
Yes, sir. Yes.
Very simple. ABC can just participate in the decision making process, but cannot force XYZ to follow what they have decided. Finished. That's it. So we are very much clear with all these structures. Now let's go ahead. So there they have given a very small tabular representation here. Whenever there is a parent, and when a parent has a subsidiary, parent has control, and what kind of like statements you'll be going to prepare? You are going to prepare consolidation. That means group accounts. When ABC, who has invested in XYZ and who has invested 30% in XYZ, so XYZ will be called as associate of ABC, and ABC has what over XYZ? Significant influence. And what will be the accounting here? Equity accounting. What is that?
Equity accounting.
What do you mean by equity accounting now? Any one of you?
So main owners of the